Archie, there are a ton of changes to all the important figures for 2024.
Let's crunch the numbers. I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to the Last Paycheck podcast. We're your hosts, Archie Hoxton and Rob Hoxton. And today we're here to talk about some of the new changes that we're seeing in the 2024 tax year, right? So 2023 is over and done. What's done is done. There's not a whole lot that can be done to plan for that. Now it's just a matter of filing. However, there's some new changes coming for this year, for 2024.
I like to call it the new numbers, right? So every year the numbers change.
Right.
And these numbers are, early in my career, I'd memorize them every year. And it's been so many years, I get them all mixed up. So that's why I've got all these papers here. But the numbers change every year, and they impact you as someone who's saving and retiring and planning for retirement or paying taxes. So it's important. And incidentally, we'll have these numbers in the notes of the show.
Yeah, absolutely. So you can review them yourself. This is something that isn't really taught in school, and it really ought to be. I think it's terrible that it's not. There's a lot of numbers to know, and they impact every one of us who works, has an income, and pays taxes. So let's dive into it. I think some of the first changes that we want to talk about are kind of like the inflation changes, right? They make changes to certain parts of the tax code to reflect the fact that prices have gone up, wages have gone up. So
let's start with the tax brackets. So there's an adjustment in the tax brackets, right? What does that mean, Archie?
Yeah. So now we'll kind of rewind and do a quick overview of our tax system here in the United States. So we have a progressive tax system, meaning that there are different brackets, right? 10%, 12%, 22%. And you get the benefit of each of those. So what do I mean by that?
The benefit of each of the tax brackets.
Well, yeah, you get the benefit of the lower tax brackets. I say that because a common misconception is that if you're in the 22% tax bracket, that's what percentage of your income you pay in taxes.
Right. That's just the marginal, right?
Yeah. That's what you pay on the next dollar. Mm-hmm. So as an example, think of it like this, just for simplicity and round numbers. Let's say you make $100,000 per year. And let's say there's just two tax brackets, 10% and 20%. 10% is up to $50,000 in income, and 20% is everything over. So that first $50,000 you make, you pay 10% on. That second $50,000 you make to make $100,000 total, you pay 20% on. So $5,000, 10% of $50,000, and $10,000, 20% of $50,000. So together you pay $15,000 in taxes. So that's what kind of the background.
This isn't how it actually works. This is just a hypothetical.
Right. Just for the round numbers, it's difficult to talk about when we've got the real brackets are a little bit more
So you have half your income at a 10% bracket, half your income at a 20% bracket. The 20% is your marginal rate.
Right.
Your average tax rate is 15%, right?
Right.
15,000 on 100,000 of income.
Right.
Okay.
Exactly.
Gotcha.
Exactly. And that's often called, you might hear that called effective tax rate. So talk about some of the changes that are coming to the tax brackets.
So the brackets are moving higher, right? Like you said, with inflation, household incomes are going up. The tax brackets are going up as well. So does that mean that because your tax brackets go up, you actually pay more in taxes?
It may actually mean the opposite. It depends on how your income changes. If you get a really, really big raise, you may end up paying more in taxes, or you may kind of break even. But let's go back to that example with making $100,000. Let's say that first tax bracket, that 10% at 50 up to 50,000. Let's say that bumps to 60,000, right? So now on 60,000 you pay 10%. On 40,000 That remainder, you pay 20%. 6,000 and 8,000. So you pay 14,000 total. So in that case, if your income didn't change, you actually will pay less in taxes by some amount. Again, if your income went up, you may break even, or you may pay more. It just all depends. But this is something that the IRS does to ensure that as your income grows, as the cost of living grows, that your tax burden doesn't kind of continually grow and grow until it gets out of control and become too great a burden on you.
So Archie, another change is there's an increase in the standard deduction.
Yeah.
Right. So maybe touch on the standard deduction and why an increase in that standard deduction could be good as well.
Yeah. So there's kind of two kinds of deductions. We've talked about this before, but you've got your standard and your itemized, right? Back in 2017, the standard went from fairly low to really high. So most people take the standard deduction now, right? Because you have to have enough itemized deductions to exceed it. It went for single people, it went from $13,850 to $14,600. And for married people, it went from $27,700 to $29,200.
So that's the amount of money that you get to not pay taxes on?
So the way it works is it reduces your taxes, right? And so, but it reduces your taxable income. So think of it back to the original example, right? You make $100,000. What you're doing is let's say, again, we're using round numbers as a hypothetical. It's easier to work with. Let's say you take as a $15,000 standard deduction, right? That reduces your $100,000 income to $85,000. So now the amount, those percentage calculations we were doing, you're working with a smaller number. So if you're paying $6,000 for 10% on that first $60,000 of income, now $20,000 is only on an additional $25,000, right, to get to $85,000, because we reduced from $100,000 to $85,000 with $15,000 in standard deduction. So then your actual tax bill ends up being $6,000 plus $5,000, $11,000. So it reduces your taxes.
Which is an 11% effective.
Right.
Okay. Gotcha.
Right. So it's all about reducing the income that you have that you would normally be reporting and paying taxes on.
Let's talk about contribution limits. So these are some of the numbers that are changing this year as well. So if we think of our 401k, some of us have 401ks, some of us have 403bs or 457s or 401as. They're all basically qualified deferred deferred contribution plans that we have through an employer. That deferral limit is going from $22,500 to $23,000 in 2024. And if you're over 50, if you're 50 or over, there's what's called a catch-up contribution. So you can actually put a little more in. That catch-up contribution is $7,500.
Right.
If you work for a small employer and you have a simple plan, like a simple 401k or a simple IRA, then the deferral amount that you can have withheld from your paycheck is going from $15,500 to $16,000, and the catch-up contribution, if you're over 50, if you're 50 or over, is staying the same as it was last year, which is $3,500. So that's nice, because if you're able to afford to do that and play catch-up, that reduces the amount of your earned income that's subject to taxes as well.
Right. Because kind of like how the standard deduction works, if you're contributing to an IRA, traditional IRA, that's important, or to a 401k or simple IRA, one of those kinds of plans, that's getting taken off the top, right? So your income is being reduced by that, much like how the standard deduction works.
Let's talk about IRAs, individual retirement accounts. So it's increasing, your deductible amount is increasing to $7,000 in 2024, which is up from $6,500, and there's a $1,000 catch-up amount that you can use if you're 50 or over. One of our favorite accounts, which we've talked about on a prior episode, is the health savings account.
Yep.
It's really the only triple tax-free opportunity that's left, thanks to the IRS.
Mm-hmm.
But these are your accounts where you're setting money aside on a pre-tax basis for future medical expenses. You can then invest the money; it grows tax deferred, and then if you use it for a qualified purpose, you can then take the money out and not pay taxes on those gains. Really awesome. Those limits are going up as well. If you're an individual and you have a high deductible insurance plan and an HSA account, that's going from $3,850 in 2023. It's going up to $4,150. If you're on a family plan, it's going from $7,750 in 2023 to $8,300 in 2024.
Yeah.
So
it's important to note that it's about the plan coverage. Is it individual coverage just for yourself, or is it family coverage for others?
Great point.
You could be an individual and have a family. Maybe one spouse has a typical PPO plan, and you have a high deductible with an HSA, and it's just coverage for you. Then you have the $4,150. So that can be kind of confusing language, as often is with tax rules. But that's important to keep in mind.
So keeping along, staying with the numbers thing, there are so many that are changing. Your Social Security benefit, if you're receiving a Social Security benefit, there's a cost of living adjustment, which we've talked about on the show. It is going up by 3.2% this year.
Mm-hmm.
So you should, if you're receiving that benefit, you should have already seen that bump in your payment. So that's an important amount. If you're worried about estate taxes, those numbers are changing as well.
Mm-hmm.
So the annual gift tax exclusion is going from $17,000 to $18,000. Okay, what that is if you want to give money to another person, maybe it's a child or a grandchild, there's an amount that you can give without impacting your basic exclusion amount, which is your lifetime amount that is free from estate taxes. And that's called the annual gift tax exclusion. So let's say, Archie, let's just say you're my son, which you happen to be, and your mom and I, let's say we decided that we wanted to give you some money. We could give you in 2024, each of us could give you $18,000 without it eroding or eating into our basic exclusion amount. Because you're married, we could actually give $18,000 from each of us to each of you. So you can do the math. What's 4 times 18? That's 72,000. 72,000 that we could give you and
put me on the spot there.
And Jenna, and then and not have to worry about eating into that basic exclusion amount. The basic exclusion amount is actually now $13,610,000 per person.
Yeah.
So if you're a married person, that's like 27,000 and change.
27 million.
27 million and change.
A lot of numbers floating around.
That you can pass to the next generation without being subject to federal estate tax.
Yeah.
Now, each state is different. You could be subject to state estate taxes, but as far as federal goes, that's the basic exclusion amount, $13,610,000 per person. It's also important to note that at the end of 2025, these estate tax numbers go away, and we revert back to a much lower number unless the Congress passes laws to make these numbers permanent.
Right.
Right. But so lots of big changes right now in the numbers.
Right. There are also a couple other changes and clarifications that have come out here in the last couple minutes we've got that I think are worth noting. The first, and we've done an episode on this, we won't dive into great detail, is that starting this year, you can roll over 529 funds into a Roth IRA for the beneficiary.
Education accounts.
Education accounts. Specifically, the 529, this doesn't apply to Coverdell or other kinds. You can roll over for the beneficiary of the 529. You can put funds from the 529 into a Roth IRA in the name of that beneficiary, subject to the same annual limit of $7,000 for this year, and subject to a lifetime limit of $35,000. So this is another great way to get some super, super powerful tax benefits, but check your state laws first. There are some states that are trying to find ways to claw back initial state tax benefits from the 529 contributions. So check on that. Another one is a change to the RMD age that has been clarified. There was much speculation on
RMD meaning?
Required minimum distribution.
Okay, that's the money that a retiree has to take out of their IRA or other retirement accounts,
right,
once they get to a certain age, because Uncle Sam wants to tax that.
Right. It applies to traditional IRAs. There was a lot of speculation on what the next move would be, whether it would be right now, it's age 73. For people born after the year 1959, it's going to be 75 for them. The first people to turn 75, born after 1959, they're going to reach 75 in 2033. So that's when this rule starts to become effective.
Archie, how about qualified charitable distribution? Since we're talking about required minimum distributions, touch on that and the change there, and then I think we're going to run out of time.
So there is a limit. So we've done an episode on qualified charitable distributions. I would recommend going and looking at that tax planning episode. So this is donating funds directly from your IRA, right? It's something that people will often do if they don't want to realize taxes when they are required to take a distribution when they reach that age 73. You can only contribute up to $100,000 out of your IRA, but that is now being indexed for inflation. That's the change, and it's going to be $105,000 for 2024, and it's likely going to continue to increase.
So you've got to have a big IRA for this to even be an issue.
Right. It's
but you don't want to overdo it. Never want to overdo it. So if you do have a big IRA and you're really charitable, just make sure in 2024 that you don't give more than $105,000 to charities directly from your IRA.
Right.
Okay.
If you're going to be close to that, it's worth looking at talking to a CPA, figuring out a good strategy for whether to donate from the IRA or just to donate and take the itemized deduction for a charitable contribution. That really is about all the time we have. So we hope this was useful to you. Like we said, we'll put these numbers in the show notes for you, so you can, as you're thinking about 2024, taxes and ways to plan ahead for filing in 2025. And so remember to like and subscribe. If you enjoyed the video, share it with your family and friends, and leave us a comment with a question if you have any. And we'll hope to see you next time. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.